Hey guys, Toby Mathis here, and today we're going to discuss the national housing shortage, how big it is, and how it affects you as a real estate investor. So let's dive on in. Number one, the data that I'm using actually came from the Harvard study. Yeah, I'm just going to jump up here, and the Joint Center for Housing Studies at Harvard University. I rely on this information quite a lot over the last many years, and a lot of really good investors that I know, very successful investors, use the same information. And what you'll see is they came out with a variety of different studies, ranging from the National Association of Home Builders to Freddie Mac to the National Association of Realtors, all using different estimates for how bad the housing crisis is as far as what is our national housing shortfall. And we're looking at everywhere from 1.5 million, so I put a dollar sign on that, 1.5 million to 5.5 million. Why is this matter? Because it's a pretty big range, and you can kind of look at their different methodologies. The National Association of Home Builders used metropolitan areas, and they looked at the home vacancy and vacancy of rental units versus normal levels to do their estimate, which is probably the least reliable. And then you had Freddie Mac using different methodology, and the National Association of Realtors, who are boots on the ground, using different. What we know is that it's going to be somewhere in that range. And when we're looking at the national housing shortage, this is from data from 2020, 20 to 2021. So what has happened in the last 3 years? Well, there's an extra 3 million visitors that have come into our country that we know of, and we continue to be underbuilt. And so, if anything, these numbers are going to be conservative estimates. Why does it matter? Because every time you hear somebody start talking about the pending, um, real estate Armageddon, which we will discuss, they're always coming up and trying to relate it back to 2008. And they're saying, hey, this is very much like 2008. The housing prices have skyrocketed. The rents aren't keeping up, which is true. But they always assume that means that the housing prices need to come down to meet the rents, as opposed to maybe the rents are going to have to go up to meet the pricing. I tend to be in that latter camp. It's a combination of the two, obviously, depending on what jurisdiction you're in and how ramped up your market got. I could see coastal cities or metropolitan areas that have these huge, massive increases, seeing a little bit of pullback, not going back to anywhere near to where they were, but perhaps coming down a little bit while rents continue to escalate. But these same people like to point to things like, oh my gosh, people aren't paying their mortgages. We're going to have massive foreclosure. You're going to see 2008 all over again. And I like just to be fact-based. Let's just look at things. National delinquency rate of first lien mortgages, we are well below average, 3.26. We're in the toilet. We saw it go up during COVID because people were not paying their mortgage because a lot of them didn't have to. And then you heard these same people that were predicting the crash back then that would say, well, there's going to be this pent up demand and there's going to be foreclosure city as soon as they have to pay their mortgages. As soon as they have to pay their student loans, we're going to see massive delinquencies. So they always do that. They always like to predict horrific things because it gets clicks. But reality wise is we're looking at, there's not a huge delinquency issue. And you should know that there's a ton of equity in these properties. In fact, equity withdrawn as a percentage of tappable equity. Look where it was back when in 2000, right before the recession, right in here, 2008. You could see people were definitely using their equity. Where are we now? We're in the toilet. Why? Well, interest rates are high. People aren't tapping their equity, but they have access to it. What happens when things get bad? Well, they start to borrow. We're already seeing the credit card debt and some of the low-lying fruit go up. But what we're not seeing is homeowners tapping into that equity. They have a ton of equity, which means not a lot of foreclosures. How do we know there's not a lot of foreclosures? Because you could look at the numbers and you could see they're really, really low. We are not in 2008 territory. Not right now. You're not seeing it. Could it go there? Nobody has a crystal ball. Nobody can predict the future. If the Fed starts raising rates again, maybe you see some negative consequences. But we have a long ways to go before we get anything even resembling something that would be considered a crash. You might see price adjustment go down a little bit, which won't be a bad thing. But if you are a real estate investor, you are experiencing the same thing I'm experiencing. It's very tough to get good deals right now. It is extremely tough. Could the market use a little bit of pullback? Yes, and it would help anybody that's trying to get investment properties. So there's people that are continuing to buy investment properties. You have funds here in Vegas, where I live. Last month, you had somebody buy over 250 properties for their fund in Vegas. They are buying like crazy when the numbers make it worthwhile, and that's the thing: is investors buy on cap. Homeowners buy on comp, right? The rest of us, retail buys on comp. Investors always buy on what they're able to make with that, and that's a factor of how much it costs to operate, how much rent they can get, and then how much the debt costs. And right now, debt is really expensive. It's starting to come down, but it's really expensive, and it still hasn't created a crash. So when we look at these things, here we go again. National Association of Home Builders says we are underwater by 1.5 million units. Freddie Mac says 3.8. And you have the National Association of Realtors saying, hey, it's actually 5.5. And then there's a variety of other estimates that has it around 7. And then this is one that you actually should be paying attention to as a landlord, especially if you're in the multifamily arena, or if you like doing single family residences, duplexes, fourplexes, things like that. And that is because according to the National Low Income Housing Coalition's latest figure, we are 7.3 million units behind. And I'll show you why that's actually important. So I'm just going to take a pause, and we're going to say, all right, let's compare the different data points and the arguments of both sides. I want to be fair here. But, so is there going to be real estate Armageddon? The people would say higher interest rates are going to bring it about. It's going to be horrible. Plus, there's higher costs, and inflation, and that's going to lead the market to go crash. You have people talking about Airbnb. Oh my gosh, Airbnb is going to leave a crash. There is an estimated, 1.3 million units, Airbnb, VRBO, housing units. Just to put that in perspective, we sell on an average year about 6 million units. And last year, I think we did right around 4 million units. It might even be below that. So if you put every single home for sale, we're talking about an extra 2 months of inventory. That's the reality. Is that going to cause a crash? I just don't see it. And maybe I should spell inflation, right? So we have the high costs. We have high interest rates. There's going to be defaults in multifamily for sure. Defaults in multifamily. Why? Because they have a bunch of loans that are resetting. When they buy those, you have set periods of time. Usually it's 5 to 7 years when you have a balloon payment. So you have all these things coming due. There's an estimated $1.5 trillion coming due in the commercial and multifamily markets. So you're going to see that play a factor. I'm already seeing distressed multifamily funds. We're seeing that being pitched to us as accredited investors all the time, as people start raising the capital to go take advantage of this situation where people are going to have a cash flow property. Let's say they have a multifamily with 200 units and it's cash flowing, and that's because their loan is at 5%. And then now they're going to have to go get a 7% loan, and now it doesn't cash flow. So they're going to sell it. They're going to dump it. And there are definitely funds out there that are saying, we'll buy it. We'll buy it. It's still a nice cash flow asset. Is that going to cause a crash? No, because there's a definite number of where that thing makes sense. It may not work for the individual that has the debt, that then they have to go out and get new financing at a higher interest rate. Maybe it's not going to work at 7%. But it'll definitely work at where they were at, probably at the 5 or 4%, which is a nice little return when you start factoring in we are completely underbuilt, and that's going to force prices upward. And that's where you look at. So then you say this versus we just have really low to no versus we have low to no inventory, right? We just don't have the levels of inventory that we're used to having. So, and it's not getting better because interest rates went up. What did you have? You have builders, you get builders slowing down. What does that mean? It means like this little chart here, right? Right. We had massive decline in housing starts during the recession, right? And it started to come back up. It's definitely been going up, but what we just saw when interest rates went up, what happened to housing starts? In the toilet. Now, this is 1.6 million units a year. To keep up with the population, we have to have about 1.5. So we are barely at keep up phase, and we are underbuilt by, depending on whose data you like, 1.5 to 7 million units. So it's going to take at least a year. If you went and if you ramped up and you increased housing starts by 500,000 a year, like you got up into here, you got up into the, hey, we're looking at pre-recession levels. Like somehow if we just massively increased, it would still take us several years to undig ourselves. And realistically, that 1.5 million units is really, really low, in my opinion. You're probably looking at a decade. So we are not in a situation where all of a sudden the issue is going to go away. The housing inventory is in the toilet. Here's the chart you could look at there. Housing inventory dropping like a rock. Existing home inventory is almost at all-time lows. It's like it hit all-time lows last year, and we're still sitting there going like, where are the units? There's nothing for sale. There's no inventory. Before it was because we were at breakneck buying. Now it's because people don't want to sell. Why don't they want to sell? Because their interest rates that they have are locked in. In fact, I think we're below, I think it's 90% of the mortgages in the US are below that magic 6% number. So we're just getting back there. So there's not a lot of people that are in that position where they're like, hey, I'd like to refi. In fact, I think it's over a quarter of the loans are below 3%, which we're not going to be anywhere near for several years, which means anybody who sells is because they're forced to sell. Maybe they pass away, maybe they have moved. Nobody who has a choice is going to sell, which means no inventory, which is right here. It backs up everything we've been saying for years, last couple years for sure, and the last 1 year for definite for sure, that we've been talking about is like there's no reason for somebody to sell if they have that mortgage on it. And as you saw, they're not even using the equity in their houses. Like we have a ridiculous amount of equity in houses, depending on what numbers you look at. It could be as high as 200,000 per unit. Here's the sales price of new homes. So this is new, and this is existing. And so I should say the median. And we've seen some pullback. This goes in course with the interest rates going up. It affects affordability. We've never been less affordable than right now as a country. I think we're really close to, like, if it's not the worst, I think we're right there knocking on the door. People are just stressed out trying to buy, which means those interest rates that they have on existing houses is going to keep them from selling and going and buying another property because they don't want to pay off a loan and then end up paying, so let's say that they sold a house and they bought the house at the same price. You're going to see just with that loan reset, increasing their payment by 25, 50%, something they're not going to want to do. And as a result, you're seeing people hang on to their houses. Now, if you're a supply and demand person, that means we have a huge amount of demand. We are underbuilt and we don't have cheap lending. So what's that going to do? It's going to keep people from putting their homes into the supply. So we have lots of demand and reduced supply. Maybe if they lower interest rates for a couple of years, and I'll show you the projections, it might make a dent, but not really. even with the interest rates, like we have not been this high for a long time. Like we got to go back a lot of years before we see interest rates this high. And it didn't cause the market to decline. It still is sticking with where it was within the last year, 2 years. Yes, we saw a major ramp up during COVID, but we're not seeing that go backwards. We're seeing continue increases in prices. In fact, last year, prices did increase on housing. So the raising of the interest rates didn't cause it to break. And now interest rates are going what direction? They are starting to go down. You're already seeing it go down. Now, can we predict what the Fed's going to do? No, they speak in riddles, those folks, but you can go to their website and you'll see written data that's going to give us their intention going forward. So you can actually go to where it says monetary policy at the Board of Governors of the Federal Reserve, and there's something called the FOMC meetings where you can actually see what their guidance is going forward. No, they don't say what they're going to do. What they often say is see our written guidance, and this is where you go get it. So you go find their monthly meetings, and you're going to look for this little thing down here called projection materials. It's right here. You can just click on that puppy, and you're going to be going and grabbing their projection materials. What does that do for us? Well, this is the projection materials right here. And this shows us, and I'll use a little highlighter thing here to actually show you. It shows us where the Fed rate is predicted to go. Right now it's at 5.4%. And you could see over the next years, it actually declining. Here, I'll actually highlight it for you so you can actually see. I'll use here, I'll write them down so you could circle, and you can see it's right now it's sitting here at this 5.4. And where do we see it going in 2026? You're looking at 2.9. In the long run, 2.5, which is about, a little bit more than half, a little bit less than half, excuse me, of where we are now. So we're going to see interest rates decline. What will it do? Well, again, everybody has an opinion on it. It means all of a sudden housing gets more affordable. And last time they did this, what did it do? It caused the market to go up. So if anybody thinks this is going to cause a market to crash, no, I just don't see it. But again, nobody has a crystal ball. I'd be really shocked to see the market go down as a result of it becoming more affordable. It usually does the opposite, especially when you have not enough supply and excess demand. So we have this huge demand and we have high interest rates, and we still see the market being pushed up. And if they start making it more affordable, then we could be off to the races again. And you're going to wish that you had purchased real estate during this time. In fact, the joke in real estate is the best time to buy real estate was always 5 years ago. Doesn't matter when. So 2024, we're looking at the estimated rate. The Fed says 4.6. That's what they're trying to get it to. The same way when they say they want inflation to be at 2%, they're saying this is where we want our monetary policy, which means eventually they're going to have to start lowering. I don't see that now. Economy's still robust. Maybe if they create a bunch of unemployment and you see a bunch of layoffs occur, maybe they'll relax it. But realistically, I just up through summer, I just don't see it. I think they're going to have to sit on their hands, but eventually they're going to lower, and eventually they're going to get it down. Like in 2025, they're looking at 3.6. Now all the people that have multifamily with resets are breathing a little bit easier. They're like, oh, if I could just wait, if I could just make it another period of time after something resets, maybe we'll be able to stomach it. Maybe you might see some of that. It's not cut and dry. It's not like what the Armageddon folks think. It's not like everything's just going to implode and it's going to be catastrophic, or we're back in 2008. Just don't see that. And again, that's because you have over and over again, we are underbuilt. We are underbuilt. And what does that mean for you? It means that when you get the opportunity to buy properties that cash flow, you buy them. It does. I don't see any data that's going to back up here we're in a crash. You might see pullbacks in hot markets, but if you're buying middle of America, if you're buying bread and butter cash flow properties like we do at Infinity Investing, which you can obviously go to infinityinvesting.com. It's absolutely free to go sign up. But if you're looking at those types of properties, you grab them and you get as many as you can, because chances are in when we look at this, if the interest rates drop, then one argument is, well, all these existing homeowners are going to sell. Okay, maybe you're going to have a little more inventory. We're really like, but it's going to take a long time for us to catch up with the increased demand. Like we just have a ton of demand. And what, by the way, if interest rates drop, do you think prices are going up or down? If history has any indication, when we drop those interest rates, it's going to cause the opposite effect. Affordability goes up. People are buying houses. If it increases more money, then that usually means people have more of something, means that the prices are going to go up. That's an inflationary push. No different than when the Fed printed, an extra $4 trillion. What did it do to interest rates? It caused them to go straight up. We always just put the inflation rate right next to the M2 money supply, and they're almost identical. They just follow themselves, right? So if they start in a situation where they start making available additional capital, what is it going to do? It's going to continue to push things up. So more demand, price increase more likely. So I just don't see demand dropping under any scenario right now. Certainly not a crash, but whatever the case, like again, nobody has that crystal ball. But what you can say is that cash flow is always king. People need a place to stay. They're underbuilt right now. There's not a lot of affordable housing. If you can help solve that issue, then you get that gold star and you get you get a reward, which is, hey, I'm going to make a lot of money over a long period of time if I do that, if I put myself in that position. So what we see, or what I see, I can only give you my opinion, is that housing prices are not going to crash. That's not, I just don't see that happening. And what we do see is a high demand, and eventually we're going to have to solve it. And we're going to solve that by either bringing more units to bear, or the existing units are going to continue to have their prices driven up. And under either scenario, as an investor, that's a very positive thing.